Hello, my name is Michael Joyce from JoycePayne Partners, and I'm pleased to share with you JoycePayne Partners' views for the spring of 2015. Mark Twain once famously said, "If you don't like the weather in New England, just wait a while and things might change." And that's exactly what's been happening with some of the financial markets. 2014 was not a great year for diversified portfolios. There was only a really narrow band of some of the largest U.S. stocks that really did well. The average U.S. stock actually had single-digit returns in 2014, and there's some other asset classes such as international equities that actually had negative returns for the year. And this year has been, at least so far, has been a little bit different. Some of the things that didn't do so well, such as the emerging markets, have really done quite well this year and have bolstered returns for the year. But there has been at least an apparent increase in volatility, and you might be wondering, what's causing that volatility? It's been a case where I think there's been 19 or 20 days in the first quarter of 2015 where the U.S. stock market was either up or down 1% for the day. Although, interestingly, there were no days where the market was up or down 2% for the day. So we're not seeing some of the extreme volatility that we saw during the financial crisis. The biggest reason for this increase in volatility is the fact that the Fed has taken their foot off the gas with their quantitative easing program. They're no longer buying government securities, they're no longer buying mortgage-backed securities. And their quantitative easing program is what really kept volatility unnaturally low for most of 2013 and 2014. So now that they've taken the foot off the gas, we've really just gone back to historical averages for volatility. So it's something that we should get used to. Another thing that has impacted volatility is the big drop in oil prices that we've talked about. Good thing overall, but it does cause economic dislocations in some areas, and that can increase the volatility. And last, the increase in the dollar relative to most of the currencies of the world also played a role in increasing volatility. In the U.S., we're about to go into what's called earnings season, where a lot of corporations are going to release their corporate earnings. And for the first time in a long time, the expectations for the earnings are really pretty dismal. And the reason for that is because there's a lot of big U.S. companies such as Caterpillar and Johnson & Johnson and IBM that do a lot of business overseas. And the strength of the dollar actually will hurt their earnings. So that is kind of baked into their stock prices. The earnings expectations are baked into their stock prices. So to the extent that they may exceed, their actual earnings exceed the earnings estimates, the market could move up a little bit more. If they don't meet those expectations, which are, as I said, already pretty dismal, then the stock market could slide a little bit. So you might be wondering, if the Fed has telegraphed that they're going to increase interest rates, why are bond yields so low? The yield on the 10-year Treasury note at this point in time is still under 2%. And again, we can point to the strength in the U.S. dollar. There's a lot of foreign investors that have seen their own currencies battered that have been flocking into U.S. Treasuries to get some exposure to U.S. dollar-denominated assets. The Fed is definitely going to increase interest rates. We just don't know when, and we're not going to project when. The head of the Richmond Federal Reserve District, Jeffrey Lacker, has said that he thinks that the Fed could raise interest rates as early as their June meeting. William Bullard, who's the head of the St. Louis Fed, thinks interest rates have to rise because the U.S. economy is about to enter a boom, which would indeed be pretty good. As I mentioned earlier, the international stock markets have done really pretty well this year, despite the fact that in some areas economic growth has been pretty slow. In the first quarter of 2015, European stocks did particularly well. Just for an example, the German stock market was up by 21% just for the quarter. However, because of the strength of the U.S. dollar, if you convert those returns for U.S. investors, it was about 7.5%. That's still not too shabby. If you think of a company like Volkswagen that does a lot of business overseas, a lot of business in the United States, the strength of the U.S. dollar has been a benefit for them because now their Volkswagens are more competitive in the U.S. market. The emerging markets have also come on really strong just in the past month or so, and that has been led by emerging Asia, which is an area that we like very much over the long term. I'd like to switch gears a little bit today and talk about some changes that are going to be occurring for participants in retirement plans such as 401ks. The Department of Labor is coming out with 2 new rules which will have a pretty sizable impact on 401ks and retirement plans. The first one is the Department of Labor is expanding the definition of a fiduciary. The Department of Labor wants retirement plans to be managed by fiduciaries, and a fiduciary is someone that by law has to place their client's interest or the interest of a retirement plan in front of their own interest. There is another standard, which is a lower standard called the suitability standard that applies to broker-dealers, but the Department of Labor wants these plans to be managed by fiduciaries, and this is a rule that we certainly applaud. The second rule that the Department of Labor is coming out with will make some of the costs of retirement plans more transparent. Some of these costs would include the investment management, the administration of the plan, custody of the plan, and even the cost of some of the underlying investments. And so far, those costs have been somewhat opaque. So this new rule will create more transparency in that area. And if you are a participant in a plan and you see that you have a pretty high cost plan, and there are many high cost plans out there, we would encourage you to go to the administrator of the plan, go to the HR department, go to your boss, and advocate for decreasing the cost for that plan. Because to the extent that you can decrease the cost, that's going to increase the returns for your plan and increase your investment returns. And over the long term, that compounding of higher returns will be a very powerful impact for you. So I've been very pleased to share with you our thoughts for the spring of 2015. If you want to know about some of our other views, please visit our website at www.JoycePaynePartners.com or follow us on Twitter at JoycePaynePTRS. I look forward to talking with you again next quarter when I will no longer have my facial hair. Thanks, and have a great day.